Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now, your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast, episode 253. Hi, I'm your host, Jacob Ayers. You're listening to another episode of Friday Fundamentals. Hey, good morning, good afternoon, good evening. Welcome back. I'm so glad you're here. Today, we're going to be discussing leverage. That is this week's Friday Fundamental. Leverage is a powerful tool. It can come in many different forms, from the mechanical leverage of a seesaw to the financial leverage of a real estate loan. We're constantly using leverage in some form or another. Leverage is defined as 1, to use something to maximum advantage, or 2, used borrowed capital for an investment, expecting the profits made to be greater than the interest payable. Financial leverage is simply borrowing money to invest with the expectation of making a profit. Leverage in the context of real estate investing is just debt. We've been conditioned to view debt, though, as a negative thing, and a bit rightfully so. But not all debt is created equal. There is good debt, which is the kind that others pay for you, and there is bad debt, the kind you have to pay yourself. Leverage is an area where many real estate investors struggle because it can be counterintuitive in the sense that real estate debt can and usually is a good thing. Let's look at just how that can be true. Leverage magnifies your return on investment, both positive and negative returns. Let's look into some investing metrics here. 2 important metrics are cash-on-cash return and return on equity, or ROE. Now let's take a duplex for example. This duplex purchase price is $100,000 and rents for $500 per unit per month for a total of $1,000. One of the most important things we consider as real estate investors is the bottom line cash flow number. That is, how much does the property profit per month after paying all of the expenses from the rental income? There are 2 ways we can look at this example. Scenario 1, which is we buy the property without leverage and pay all cash for it. And scenario 2, where we buy the property with leverage by borrowing money from a bank and putting down 20% of the purchase price, which is $20,000. Now let's look at scenario 1, where we do not use leverage. The monthly cash flow analysis looks like this. We have $1,000 in monthly rents minus $400 in expenses for vacancy, insurance, maintenance, taxes, utilities, and management. $1,000 minus $400 in expenses leaves $600 per month in positive cash flow. Now let's look at scenario 2, where we use leverage and put down 20%. Our loan for the remaining 80% is a 30-year fixed rate with a 4% interest rate. So we have the same $1,000 in monthly rents, deduct our same $400 in expenses, and now we have to pay our mortgage, our principal and interest payment, which is $382. So we take our same $1,000 in monthly rents, subtract our $400 in expenses, subtract our mortgage payment of $382, and we're left with $218 per month in positive cash flow. Now, at first glance, you might look at scenario 1 with the $600 per month cash flow as outweighing the $218 per month cash flow in scenario 2. But let's compare the important cash-on-cash returns. Remember, in scenario 1, we paid $100,000 for the property in cash up front. This property makes $600 per month, or $7,200 per year. We take $7,200 per year divided by our $100,000 investment, and we get a 7.2% cash-on-cash return. In scenario 2, we put just $20,000 down for the property, and it makes $218 per month in cash flow, or $2,616 per year. So we take our $2,616 per year, divide by our $20,000 down payment, and we get a 13% cash-on-cash return in scenario 2, compared to just 7.2% cash-on-cash return in scenario 1. That other important metric we mentioned is the return on equity, or ROE. Let's calculate the return on equity of each scenario. In both examples, our $100,000 duplex appreciates 5% over 1 year. So in scenario 1, without leverage, after 1 year, our property is now worth 5% more, or $105,000. We made $5,000 from the appreciation of our property. This $5,000 divided by our initial $100,000 investment equals 5% ROE. In scenario 2, where we did use leverage, after 1 year, our property is now worth 5% more, just as in scenario 1, now worth $105,000. We made the same $5,000 from appreciation of our property, but this time we take our $5,000 in appreciation divided by our initial $20,000 down payment, which equals a 25% ROE, as compared to the 5% ROE in scenario 1. With these two cash-on-cash and return on equity metrics, you can begin to see how leverage magnifies our returns. Robert Kiyosaki said, "Savers are losers and debtors are winners." Yes, Robert Kiyosaki, author of Rich Dad, Poor Dad, said, "Savers are losers and debtors are winners." The ability to leverage debt is what makes real estate investing so powerful. When you use debt, you can control property for a fraction of the cost of that property, allowing you to spread your money across several different properties. Now, when you invest your money across more than one property, you not only increase your returns with leverage, but you accelerate the velocity of your money. If you can control 5 properties with a 20% down payment for each, you then get to realize that appreciation for each of those properties, along with the leveraged cash-on-cash returns. Remember, you want to be a debtor, as Robert Kiyosaki says. Now, I understand this concept can take some time to fully understand. On the surface, it may sound simple to you, or it may sound like it doesn't make sense at all. Either way, I encourage you to give it some thought and look at the numbers. Go back and look at these examples. You can find all of these in the show notes at www.jacobayers.com/253, where you can see all of the breakdowns in these monthly expenses, the cash-on-cash calculations, the return on equity calculations, and all of that, and make the decision for yourself. After all, you're doing this for the numbers, so it makes sense to be able to understand those and calculate and do what makes sense for you. Well, hey, that wraps up this week's episode of Friday Fundamentals. Hey, I hope you're getting value from this podcast. If you like what you heard, please go over and leave a rating and review on whichever platform you're listening on. It would mean so much. For more information, resources, to connect with me, reach out to me. You can do so at www.jacobayers.com. Till next week, engineer the lifestyle you want.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.